What if I told you that the exhausting mental gymnastics of memorizing dozens of complex candlestick patterns, from hammers and dojis to engulfing bars and shooting stars, is actually sabotaging your trading consistency? What if you could strip your charts entirely clean, focus on just the last two completed candles, and instantly decode exact market sentiment in real time? Let's be completely honest about traditional chart reading. Classic candlestick patterns are highly seductive, but they fail far more often than the textbooks care to admit. I used to think I had candlesticks entirely figured out. I would spot a pristine hammer perfectly tapping a major support level, execute my buy order, and watch the market immediately cave in. I'd see a massive textbook green breakout candle, jump in and get trapped in a brutal reversal. I fell into that cycle over and over again until I was completely broke and frustrated. Everything shifted for me a few months ago when I stumbled across a book by Lance Beggs titled YTC Price Action Trader. Tucked away inside those pages was a masterclass section dedicated to the two-candle theory. It completely dismantled and rebuilt the way I interpret raw price action. No more guessing, no more praying, and no more relying on rigid patterns that only work in hindsight. By mastering the relationship between just two candles, I gained the ability to see exactly whether the market was inherently bullish, bearish, or quietly moving sideways. Over the next few minutes, I'm going to pass that exact blueprint directly to you. First, we're going to break down the core mechanics of the two-candle theory. From there, we'll open up a live, real-time chart to trace the flow of institutional money together. Finally, I'll show you exactly how to formulate high-probability trade setups using this framework. If you've spent your trading career feeling like you're constantly chasing the market, you cannot afford to miss what I'm about to say. The two-candle theory isn't just another collection of static shapes for you to memorize. It is an active, continuous process. Think about how standard candlestick technical analysis works. You memorize a specific visual shape, sit by your screen waiting for the chart to magically print that exact pattern, and then blindly execute a trade the moment it appears. While you're waiting, you completely ignore the dozens of other candles forming around it, treating them as if they are entirely irrelevant to the story. When you say it out loud, doesn't that sound incredibly foolish? This is where the two-candle theory radically diverges. Instead of waiting for an isolated signal, we perform a continuous initial assessment to establish the current market bias, whether we are operating in a bullish, bearish, or sideways environment. Then, with the birth and completion of every single subsequent candle, we evaluate whether the new data actively supports or violently contradicts our established bias. Imagine we establish a structural bullish bias at the open of a session. As each new candle matures, we don't just passively look at it. We ask whether it validates our upward thesis. Take a look at this specific pullback. The market drops, printing three distinct candles that explicitly reveal the buyers are hemorrhaging strength while sellers are aggressively driving liquidity down. When the market attempts to bounce, it prints a deeply pathetic, weak upward move before instantly snapping backward and crashing. That is the raw diagnostic power of tracking candle relationships in sequence. To successfully weaponize this theory in your daily trading, you only need to master two fundamental pillars: close position and close comparison. Let's unpack close position first. This mechanic allows us to mathematically measure the internal strength of a single candle's bullishness or bearishness without caring about what color it prints. To calculate this, you take the absolute high to low range of the candle and divide it into three completely equal zones: the upper third, the mid-third, and the lower third. We then look at exactly where the closing price settled within that structural grid. A high close candle is any bar where the final closing price settles firmly within the upper third of its overall range. Picture 6 completely different looking candles that all share one trait. They all manage to close in their upper third. Every single one of them represents an underlying bullish sentiment for that specific block of time. However, their internal structural strength is vastly different. If we isolate Candle 1 and Candle 2, we see a fascinating story. Candle 2 opened at the absolute floor of its range and closed dead on its highs, proving that the bears offered zero resistance. The bulls completely dominated the court. Candle 1, on the other hand, tells us that after the open, the bears actually seized control first, driving the price deep into the lows before the bulls woke up, absorbed the supply, and violently engineered a rally back to the highs. Both are high close candles, but Candle 2 is structurally far more aggressively bullish than Candle 1. Next, we have mid-close candles, where the closing price settles directly within the middle third of the total range. These bars are inherently neutral because they represent a classic tug of war where the price expanded both above and below the open, before flatlining right back to the center. But even within neutrality, there are critical nuances. If you look closely at these mid-close examples, candle 3 closes toward the top edge of the middle zone, giving it a subtle bullish undertone, while candle 6 settles toward the bottom edge, whispering that the bears are quietly gaining a slight advantage. Finally, we have low-close candles, where the price closes definitively in the lower third of its structural range, telegraphing a clear bearish sentiment. Let's look at the nuance between these low-close bars. On candle 1, the bulls actually managed to drive the market up to create a prominent high early in the session, only for a wave of aggressive sellers to enter, wipe out the gains, and force a red close. But look at candle 3. The moment the session opened, the sellers took the wheel and relentlessly drove the market straight down without a single moment of hesitation, closing dead on the lows. By reading the actual mechanics behind the wicks, it becomes blindingly obvious that candle 3 represents a far more savage environment of bearish control than candle 1. Once you can read a single candle's internal sentiment using its close position, it's time to supercharge your analysis by layering in close comparison. This is where we compare the closing price of our current live candle directly against the entire high to low territory of the previous candle. This classifies our active bar into one of 3 distinct structural profiles: a bull candle, a bear candle, or a range candle. A bull candle occurs when the current session's closing price breaks completely out of and closes above the previous candle's absolute high. It tells you that buyers are aggressively expanding the boundaries of value and forcing the market into a bullish sentiment. Conversely, a bear candle materializes when the current close prints entirely below the previous candle's absolute low. This is a definitive sign that sellers are actively conquering new territory and driving deep bearish momentum. A range candle occurs when the current candle's close finishes completely trapped inside the high to low boundary of the previous candle. This is the ultimate signature of a market bottleneck, a visual proof that buyers and sellers are deadlocked in a brutal, evenly matched brawl, indicating a ranging or completely sideways market state. To make this immediately actionable on a live chart, we marry these 2 core concepts together into a flawless diagnostic matrix. Picture a grid. On our x-axis, we map out our 3 close comparison profiles, bull, range, and bear candles. On our y-axis, we align our 3 close position categories, high, mid, and low closes. This grid yields exactly 9 structural candle combinations. Let's walk through every single one of them, so you can see how they tell the story of the tape. The high close bull candle sits at the absolute top of the food chain as the most aggressively bullish signature the market can produce. This occurs when a candle closes entirely above the previous bar's high while simultaneously stamping its close in the upper third of its own range. It screams that buyers are operating with immense, unimpeded velocity, effortlessly vaporizing every single resting sell order and locking the price in dead at the highs. The mid-close bull candle features a close that breaks above the previous candle's high but settles down into the middle third of its own active range. The macro sentiment here remains firmly bullish because new ground was broken. But it flashes a minor warning sign. Sellers stepped in at the absolute highs and managed to successfully push the price back down before the close. The bulls still own the field, but their armor has a small dent. The low close bull candle presents a highly fascinating anomaly. The price manages to close above the previous candle's high, but it closes in the bottom third of its own range. This tells us that while the bulls technically achieved a higher price milestone, a massive wave of supply met them at the highs, allowing the bears to completely hijack the session and drive the price all the way down to its floor before the bell. The sentiment is technically bullish on paper, but the internal momentum is deeply exhausted and dangerously weak. The high close range candle closes completely inside the body territory of the previous bar, but settles its own close in its upper third. The overarching macro context here is strictly sideways and neutral, but the short-term order flow reveals that buyers completely dominated the lower prices, absorbing the internal supply and carving out a strong, localized bullish tilt within an overall flat market. The mid-close range candle represents the absolute epicenter of pure financial equilibrium. This bar closes inside the previous candle's range and right in the dead center of its own middle third. It signals an intense, highly balanced stalemate where neither supply nor demand can move the needle, leaving the market in a state of absolute compression. The low close range candle closes safely within the prior candle's boundaries, but forces its own close down into its lower third. While the market remains structurally directionless and sideways on the macro view, the internal order flow shows that sellers cleanly won the in-trade candle battle, pushing prices to the floor and holding them there, signaling a subtle bearish undertone within a neutral market. The high close bear candle breaks out and closes beneath the previous candle's low, but manages to pull itself up into the upper third of its own range before concluding. The macro bias here is definitively bearish because a structural low was breached, but it flashes a massive sign of caution. Buyers stepped into the deep lows with real urgency, aggressively lifting the market back up toward its open. The bears are in control, but they are losing fuel rapidly. The mid-close bear candle closes below the previous candle's low, but settles its close cleanly in the middle third of its own range. This marks a scenario where sellers are demonstrably stronger than buyers on the macro horizon, but responsive buyers are actively present, fighting back from the session lows and forcing a mildly weakened bearish extension. Finally, the low close bear candle stands as the ultimate, undisputed heavyweight champion of bearish destruction. This occurs when a candle closes completely below the previous bar's low, while simultaneously locking its own close in the absolute bottom third of its range. It signals an overwhelming, unmitigated wave of institutional selling pressure that is completely flattening every single buy order in its path. You don't need to stress about flashcards or memorizing these 9 profiles. Once you start actively applying the twin filters of close position and close comparison to your live workspace, reading them will become as natural as breathing. But to truly unlock this power, you have to watch it unfold in a live environment. Let's open up a 5-minute chart of the S&P 500 index. We locate the very first candle of the trading day. Because this theory relies fundamentally on the relationship between 2 data points, we completely ignore the opening candle and patiently wait for the second bar to print to establish our baseline context. The second bar closes as a high close range candle. This immediately whispers to us that even though the market dipped lower initially, responsive buyers rushed in at the lows to force a high close. Buyers are actively lurking at these discounted prices. Immediately after, the chart prints a low close range candle. It looks like the sellers are trying to push back, but because both of these initial candles are strictly range candles trapped inside the opening boundaries, our baseline bias remains completely neutral. We are sitting on our hands. The next bar matures into a high close range candle. This tells us the sellers completely failed to establish new lows below the previous bar. The moment they tried, buyers stepped in and aggressively reversed the price upward. We are still locked inside a tight, messy range, but the internal spring is winding up. The very next candle prints as a low close range candle, proving that the overhead sellers who capped the market earlier are still fiercely defending their territory. At this exact junction, we can visually see a classic, localized tug of war. The market is completely trapped in a sideways box. Buyers are protecting the floor, sellers are walling off the ceiling, and the price is compressing right in the middle. Then, the silence breaks. The chart prints a massive low close bear candle. For the very first time all morning, the market produces a definitive breakout candle that obliterates the prior range and locks in dead on its lows. This is a massive show of force from the bears. If this momentum is real and institutional, we need to see clean, immediate follow-through. If we get consecutive bear candles here, we will officially flip our structural bias to bearish. But look at what happens next. The market completely denies the bears, printing a massive high close bull candle. This is a violent, immediate rejection. It tells us that massive institutional buyers stepped up at the lows, completely absorbed the selling pressure, and rocketed the market right back up to close at the highs. This is immediately followed by another dominant, high close bull candle. For the first time all day, we have a powerful breakout paired with genuine back-to-back follow-through. The buyers are playing for keeps. At this exact moment, we confidently flip our master market bias to bullish. The next candle closes as a mid-close range candle. This represents a brief, natural breath in the trend, a temporary pause, but nothing structurally threatening. Right on cue, the next bar prints a gorgeous high-close bull candle, perfectly aligning with our macro bias as the trend resumes its upward march. Then a warning sign appears. A low close range candle. This signals that sellers have aggressively re-entered the arena at these new highs, hammering the price all the way back down to its open. This is our cue to exercise extreme caution. The market is teetering on a brief pause or a deep pullback. The subsequent bar closes as a high close range candle. In this exact context, it tells us that the buyers successfully defended the lower boundary of the pullback. The sellers who looked threatening in the previous candle completely failed to follow through and establish lower prices. The bulls staged a beautiful recovery. We then print a tiny, compressed mid-close range candle, indicating another brief micro-deadlock. If the chart prints 3 or 4 more of these, we would label this a sideways distribution range. Instead, the bulls explode back onto the scene with a massive high-close bull candle. The buyers have officially broken the deadlock and taken back total control, signaling that another leg up is highly probable. But watch the very next bar. It closes as a mid-close bull candle. This is a subtle, creeping sign of structural exhaustion. The previous candle was an absolute powerhouse breakout that should have ignited a massive run. If the buyers were truly operating with unbridled strength, the momentum should have effortlessly sustained itself. Why did they suddenly fail to extend the price higher? The overarching trend is technically still bullish, but our risk radar is officially on high alert. The hammer drops on the very next bar. A devastating low-close bear candle slashes through the chart. This is the most aggressive bearish signature possible. The upward structure is cracking, and institutional sellers are flooding the market. It might just turn out to be a deep pullback within the macro trend, but it carries serious weight. The pristine uptrend is officially broken. The market confirms this by printing a second consecutive low-close bear candle. This is the definitive follow-through the sellers needed. At this exact junction, there is a massive probability that the entire market sentiment has formally reversed. Suddenly, a glimmer of buying interest appears via a high close range candle. This reveals that buyers are attempting to mount a defense at these discounted lows, fighting back against the waterfall drop. The next bar closes as a mid-close bull candle, showing that while the buyers are trying to pilot a recovery, the sellers are actively meeting them with massive resistance. The chart has devolved into a short-term, messy sideways brawl. Our master sentiment officially resets to completely neutral. The bulls try one last push, printing a strong high-close bull candle that signals they are attempting to reclaim the driver's seat. If the market can print a clean upward follow-through candle next, it will prove that this entire drop was just a deep pullback and the macro uptrend is safe. Instead, the market produces a devastating low close range candle. This tells us that the sellers are heavily stacked at the highs, completely stuffing the bull's breakout attempt and forcing the price back down. The next bar prints as a mid-close range candle, heavily validating our neutral sideways diagnosis. Over the next few bars, the chart prints a series of indecisive mid-close candles, completely locking the market in a flat line. Then, the trapdoor opens. A sharp, low-close bear candle slices through the floor, signaling an immediate short-term bearish takeover. This is backed up by two more consecutive dominant, low-close bear candles. The structural evidence is now undeniable. The market has collapsed into a verified downtrend, our master bias is completely bearish, and the price proceeds to slide aggressively lower for the remainder of the trading day. Now that you have seen exactly how to fluidly decode a live chart candle by candle, let's take this diagnostic superpower and combine it with key support and resistance levels to engineer institutional-grade trade setups. We open up a fresh chart and anchor our analysis right here on this candle. It prints as a high close-range candle, telling us we are navigating a sideways market that possesses a mild, underlying bullish undertone. The historical data to the left perfectly confirms this, showing a flat horizontal consolidation. The next bar finishes as a mid-close range candle, further solidifying our sideways range thesis. Suddenly, the market shifts gears, printing a massive high close bull candle. This is a violent, sudden breakout of the baseline bias, the strongest possible signal that an explosive upward expansion is beginning. But as professional price action traders, we never blindly buy the absolute tip of a breakout bar. We must wait for the structural trend to prove its sustainability. Our patience pays off when the very next bar also closes as a dominant high-close bull candle. Seeing two of these ultra-aggressive signatures printed back-to-back confirms that institutional buyers have entered the market with serious size, violently driving prices higher. The chart then prints a low close-range candle, a minor bearish signature wrapped in a neutral shell. Because the market just engineered a rapid 5-candle expansion, a corrective pullback is entirely healthy and expected. This pause will likely take the form of a tight consolidation range over the next few bars, and since the candlestick architecture isn't showing overwhelming bearish strength, our master uptrend bias remains perfectly intact. The next bar heavily validates our patience, closing as a high close range candle. The sellers completely owned the previous candle, but the bulls immediately stepped into the arena and took back the steering wheel, leaving the sellers with zero follow-through capability. Buyers are aggressively buying every single microdip, signaling that they have no intention of letting this market drop. The next candle closes as a low close bull candle. It's a green bar, but notice how sellers stepped in heavily at the absolute highs to smash the price back down to the lower third. This order flow makes perfect structural sense when we look to the left and realize the price just tapped a major historical ceiling. We cleanly mark this line as our major resistance level. If our upward thesis is correct, the bulls should completely absorb this supply and engineer a massive breakout above this ceiling within the next few bars. We are hunting for a buy trade the moment that breakout triggers, but for now, we wait. The next candle proves the bulls are completely unfazed by the resistance level, printing a beautiful high close range candle that stands in direct opposition to the previous bar. The sellers tried to use that overhead ceiling to spark a major sell-off, but buyers viewed those lower prices as an absolute gift, stepping in with massive urgency to sweep the market right back up to the highs. The spring is incredibly tight. We are locked in a minor compression range right beneath a major breakout level within an overall powerful uptrend. Then, the dam breaks. A majestic high close bull candle explodes directly through our marked resistance level. This is a flawless, high probability breakout signature appearing precisely where it matters most. It confirms that the ceiling has been shattered and the upward trend is ready to run. We execute a market buy trade the exact split second this breakout candle closes. We place our protective stop loss safely below the low of this breakout bar, and we set our take profit target at a highly structured 1 to 1.5 risk to reward ratio. Our rules are clear. If the internal candle sentiment shifts dramatically against us while the trade is active, we will exit immediately. The next bar prints as a mid-close range candle, showing a lack of immediate aggressive follow-through right after our entry. Because we are already locked into a live position, this acts as a minor sign of caution, but since the pattern is inherently neutral, there is no structural reason to panic. We stick to the plan and hold the trade. The market then edges up with a high close range candle, proving the bulls are still actively grinding upward, though we remain stuck in a minor consolidation. This is followed by a low close range candle, reminding us that we are still in a tight fistfight and the buyers haven't completely broken away yet. The sellers are contesting every single pip. Then a wave of anxiety hits the chart. A sharp, low close bear candle prints against us. This is a prominent bearish signature and a legitimate cause for concern. But we look at the broader context. The price has dropped right back down to retest our old resistance line, which should now act as a new structural support floor. If our macro bias is correct, the sellers cannot provide follow-through here. The very next candle must show positive buying response. If the next bar closes bearish, it proves the support floor has completely failed, and we will immediately cut our trade for a small loss and flip our bias to bearish. Instead, the bulls deliver an absolute masterpiece. A massive high close bull candle materializes, completely vaporizing the sellers and blowing them out of the water. It is a spectacular structural confirmation that the support floor is rock solid and the buyers completely own this market. If you missed the initial breakout entry, this bar provides a perfect secondary entry point to buy the market. As you can see, the price immediately launches into a powerful, unimpeded upward rally, effortlessly smashing right through our profit targets. Let's dissect one final, highly instructive example. On this chart, the market has been locked in a beautiful, highly consistent uptrend for several hours. As we trace the up move, we can spot a steady rhythm of dominant high close bull candles, almost all of which enjoy clean, immediate upward follow-through. On the flip side, whenever a low close bear candle attempts to print against the trend, it completely fails to secure any follow-through. The market instantly reverses them and continues higher. This is the definition of a pristine, healthy uptrend. Currently, the market enters a natural pullback, and we watch as a fresh cluster of high, close bull candles begins to emerge near the bottom, signaling a positive turn. However, if you look closer, a massive structural warning sign has quietly developed. During this specific pullback, for the absolute first time in this entire multi-hour uptrend, the market printed a low close bear candle that successfully achieved clean, consecutive downward follow-through. This is a massive red flag. It tells us that institutional short sellers have actively entered this price zone and are successfully holding ground. The macro trend is technically still pointing up, but the internal mechanics are shifting. The latest bar finishes as a mid-close bear candle. The order flow shows that sellers aggressively drove the market down with real urgency, but buyers managed to mount a late-session counterattack to pull the close back to the exact midpoint. The trend is still upward, but we are walking on eggshells. The next bar provides a temporary sigh of relief, printing as a high close range candle to show buyers taking control of this localized one-candle boundary. This is immediately backed up by a strong high close bull candle, signaling that the bulls are making a definitive run to reclaim total control and push the market back to the swing highs. However, the follow-through is deeply disappointing, printing as a tired mid-close bull candle. It's technically green, but it confirms that institutional sellers are fiercely defending these highs, waiting to ambush the bulls. The buyers dig deep and print another high close bull candle, a beautiful sign on the surface, showing they've absorbed the supply and forced a close at the highs. But when we look at the next bar, there is zero upward continuation. This tells an ominous story. The bulls spent all their available fuel absorbing those sell orders, and they have absolutely nothing left in the tank. This exhaustion is heavily confirmed on the next mid-close bull candle, where buyers tried to push higher but were instantly stuffed by sellers. The market then stalls into 3 consecutive low close range candles, trapping the price in a horizontal box. The buyers repeatedly attempted to lift the market to the highs, but every single attempt was ruthlessly absorbed by sellers who forced the close back down to the floor of the bars. At this exact junction, we know the buyers are completely exhausted, but since we haven't seen an explosive show of force from the sellers yet, the context remains strictly neutral. We are waiting for the trigger. The trigger lands with absolute authority. A massive, sweeping low close bear candle tears through the chart. The sheer size of this bar reveals immense institutional urgency from the sellers. This is their first true show of absolute dominance, but as disciplined traders, we require follow-through before executing. The next bar prints as a high close range candle, showing a brief, desperate attempt by the buyers to stabilize the floor. But the bears completely crush the counterattack, printing a dominant low close bear candle that is immediately backed up by another aggressive low close bear candle. For the first time in the entire narrative, the sellers have secured a powerful, undeniable breakout paired with structural follow-through. The uptrend is dead, the macro trend has officially reversed, and the bears are firmly in control of the ship. Notice how easily the price violently slices straight through our major historical support levels, without showing a single ounce of hesitation. To capture this move safely, we wait for a clean structural break of the support floor. This massive low close bear candle closes cleanly beneath the support line, locking in a flawless bearish entry signal. We execute a market sell trade at the close of this bar, place our protective stop loss safely above the swing high, and actively manage our risk as the market collapses into a massive downward waterfall for the rest of the day. That brings us to the end of this breakdown. If there is one thing I want you to take away from this video, it's this. Please do not trust my words blindly. Take this exact 2-candle framework, open up your own charts tonight, and actively track the order flow yourself until it clicks. The market is a living, breathing teacher that uncovers new data every single day, and the most profitable traders on earth are simply the ones who never stop learning. If you found massive value in this video, please smash that like button, subscribe to the channel, and turn on notifications so you never miss a lesson. Until next time, trade smart, ruthlessly manage your risk, and remain intensely patient. Thank you so much for watching, and I'll see you in the next one.